Hello, everybody. I am Joe Gallimore, Director of Investment Management with Argent Bridge Advisors. Welcome back to another Cup of Joe. And since the stock indexes seem to be relatively quiet right now and volatility seems to have calmed down, I want to take this opportunity to step out from the normal format and talk about just one subject today. And it's something we're hearing a lot about, which is inflation. I want to kind of describe the problem in real world terms of inflation and then follow up with two natural questions that usually stem from talking about the inflation issue. So first, what exactly is inflation we're dealing with right now? I'm going to talk about it in kind of two senses because not all inflation is created equal. The first I'm going to refer to as sticky inflation. And unfortunately, this happens in areas that you're probably going to notice most. Things such as eating out, the cost of your latte at Starbucks, or services you consume like getting a haircut or getting your nails done, or even the cost of Amazon Prime, which is going up $20. And I say these are sticky, and I say the word unfortunate because these, when headline inflation, when you hear the inflation numbers on the news saying inflation's coming down, these are going to be slower to react. These aren't going to come down as quickly as other inflation will. Now, the not so sticky inflation is in areas that react more quickly. And if you've been listening to the news for the past year or so, you've been hearing the word transitory. And this is where that term applies. Things like the costs of manufacturing inputs, industrial metals, agriculture, things like semiconductors, all that. In these areas, this is where there is demand for these things, but supply just needs to catch up with that demand. There's a squeeze on supply right now, and that's why prices have been driven up there. So once supply catches up to demand, things like the cost of new cars and other manufactured goods usually come down to meet that. And so not so sticky inflation recedes, like I just said, when supply is increased to demand or the demand for those goods wanes. But unfortunately, sticky inflation changes much more slowly since they're driven primarily by consumer behavior, which can often take a long time to shift. Now, one asterisk on both of these sections is the price of energy. And energy has recovered very strongly from an immense low during the pandemic shutdowns of 2020. And energy inflation is so pervasive because it's felt both on the personal side when you buy gas at the pump, but it's also felt as an input cost into the goods and services that we consume. And this is usually one of the first costs that's passed on to the consumers. So things like the cost of a plane ticket are significantly affected by the cost of energy. And when energy costs come down, so will the cost of a plane ticket, hopefully. Now, once economies renormalize, and the demand for energy kind of stabilizes, the price of energy should come down as well. And most economic strategists out there I'm listening to right now think that higher prices are going to be up for a little while. They're going to be around for some time. So that leads to two questions. The first question is, well, what can we do about it? For some of it, a lot of it actually, there's nothing we can do about it. We can't control the cost of steel or metals. We can't affect the supply chain logistics we're hearing a lot about with cargo ships stuck outside of the ports. And we can't increase the labor supply. We can't fill those job openings that will open up a lot more supply of the services that we want to consume. These are all factors that will work themselves out, and they raise supply to meet demand, which in turn lowers costs. Now, the one thing you can control is your spending. Simply being aware that your $10 is not going to go as far as it usually would right now, and maybe making small tweaks to your regular spending or maybe delaying larger purchases, those can have significant effects while the cost of living is elevated. And of course, if you need guidance on this, just call your financial advisor. That's what we're here for. But affecting that portfolio distribution and how much money you're spending while the costs are greater is what you can focus on during this time. Now, how does this affect my portfolio? Investors usually hear the word inflation and think, oh no, my bonds. This is terrible for my bond portfolio. Well, while it's true that inflation does affect the purchasing power of the coupons that your bonds pay, not all portfolio income comes from your bonds section. When you need distributions from your portfolio, we take that from areas that have done well and leave the bonds alone. So we're not selling while those are combating inflation. And of course, equities pay dividends, which are actually much less sensitive to inflation. And when it comes to bonds, let's remember that a bond's purpose, a bond's purpose is not only to provide income. It's not like all of a sudden bonds are a bad investment because inflation's higher. No, bonds also serve as when there's a big, sustained or sharp, quick equity market correction. Bonds are the area that ballast your portfolio. So they serve multiple purposes other than just providing income. The second factor here is that equities traditionally are the best hedge against inflation. Even though inflation is high right now, the economy is still growing. And the best way to take advantage of that is through owning stocks. And as we all know, $1 million is not what it used to be. It used to be the goal for your nest egg. Well, a 30-year retirement might cost more than $1 million these days. And the proven best way to combat rising costs of living from decade to decade to decade is by staying invested in equities. And the final thing when it comes to your portfolio is that we are actively incorporating assets in there that actually benefit from inflation. These are things like commodities, precious metals, agriculture, infrastructure, and real estate that benefit from the higher prices and the rise in inflation. So I hope that provides a lot more context for when you hear inflation. Right now, it's a hot buzzword that is usually meant to intimidate, but a better understanding usually leads to better peace of mind. So if you have any further questions on it, please feel free to reach out to us. We are always happy to talk about it. And until next time, take care.